For more than a decade, JPMorgan was viewed as the quiet weight on the silver market. Not because it disliked silver, but because suppressing silver served a larger function inside the financial system. That role has now changed, and the change is already visible in the data. JPMorgan is no longer positioned as the market's primary counterweight. It is no longer acting as the absorber of excess demand through paper supply. Instead, it has stepped aside. In some cases, it has stepped in the opposite direction. That is the switch the market has not fully processed. This is not a moral story. JPMorgan did not suddenly discover fairness or abandon profit. Banks do not operate that way. What changed was risk. Suppression stopped being a stabilizing strategy and started becoming a liability. When physical inventories tighten and delivery risk rises, the institution that once capped prices becomes the one most exposed to failure. The popular narrative still focuses on manipulation. That framing is now outdated. Manipulation implies control. Control implies confidence. What we are seeing instead is repositioning. JPMorgan reduced its exposure to being the backstop of a paper-heavy system and increased its exposure to physical optionality. That is not bullishness. That is survival. Markets are misreading this shift as neutrality. They assume JPMorgan stepping back means the pressure is gone. In reality, it means the pressure has been transferred. The bank that once kept the lid on silver is no longer willing to stay underneath it. When the largest and most sophisticated participant in a market changes sides, not loudly, not publicly, but structurally, the consequences are rarely immediate. They are gradual, then sudden. And by the time they are obvious, the positioning opportunity is already gone. What looks like calm today is not equilibrium. It is the absence of a stabilizer. For decades, silver did not trade as a normal commodity. It traded as a financial instrument first and a physical metal second. That distinction explains almost everything that followed. At the center of this structure sat a paper market. Futures contracts on COMEX, unallocated accounts in London, and large exchange-traded funds created a layer of synthetic supply far larger than the underlying metal. 1 ounce in a vault could support dozens of paper claims. Liquidity appeared deep, volatility appeared contained. But the stability was engineered, not organic. The system worked because most participants never asked for delivery. Futures were rolled. ETFs were traded for price exposure, not metal ownership. Settlement occurred in cash. As long as confidence held, paper silver functioned as a substitute for physical silver. Price discovery happened in derivatives, not vaults. Banks played a critical role in maintaining that structure. As market makers, they provided the short side when demand surged. When prices threatened to rise too quickly, paper supply expanded. New contracts absorbed buying pressure without requiring new metal. This was not altruism, it was a business model. Suppressing silver delivered systemic benefits. First, it anchored inflation expectations. Silver has always been a monetary signal. When it rises sharply, it draws attention to currency debasement. Keeping silver quiet helped keep inflation psychology contained, even when monetary expansion accelerated elsewhere. Second, it protected fiat credibility. A rapidly rising silver price would have challenged the perception that paper currencies retained purchasing power. Gold alone could be dismissed as a niche hedge. Silver, with its industrial footprint and historical monetary role, was harder to ignore. Stability in silver reinforced confidence in the broader monetary framework. Third, it supported the bond market. Low inflation expectations allowed yields to remain suppressed. That lowered government borrowing costs and sustained demand for sovereign debt. In that sense, silver suppression was not isolated. It was a pressure valve inside a larger financial architecture. JPMorgan inherited a central role in this regime after the collapse of Bear Stearns in 2008. Along with Bear's assets came substantial silver short exposure. Over time, JPMorgan became the dominant participant on the short side of the futures market. Public positioning data repeatedly showed its footprint during periods of price stress. This role was often misunderstood. JPMorgan was not betting against silver in a directional sense. It was acting as a stabilizer, absorbing excess demand when the system required it. The profits came from spreads, financing, and control of flow, not from silver falling to zero. For years, the arrangement held. Physical inventories were sufficient. Delivery requests were manageable. paper claims cleared without friction. Price spikes were capped and volatility was contained. But this regime depended on one condition above all others: the assumption that physical supply would always be adequate if called upon. Once that assumption weakened, the logic of suppression inverted. The old system was not dismantled overnight. It eroded quietly, under the weight of structural change. And when that erosion reached a critical point, the incentives that once justified suppression began to disappear. The silver market did not fracture because investors suddenly turned enthusiastic. It fractured because demand crossed a structural threshold that paper mechanisms could no longer absorb. Industrial consumption fundamentally changed the equation. Solar manufacturing scaled faster than any prior energy transition. Each photovoltaic panel requires silver paste for conductivity, with no viable substitute at scale. Electric vehicles added another layer of demand, using roughly 2 to 3 times more silver than internal combustion cars. At the same time, 5G networks, AI data centers, and advanced electronics expanded aggressively, all dependent on silver's unmatched electrical properties. This was not cyclical demand. It was policy-driven, capital-backed, and persistent. Supply, however, lost flexibility. Silver is not mined on its own terms. Roughly 70% of global production comes as a byproduct of zinc, lead, and copper mining. That means silver output responds to base metal economics, not silver prices. Even when silver demand surges, miners cannot simply increase production. If copper or zinc prices do not justify expansion, the silver never appears. Primary silver mines offered little relief. Output has trended lower for years as ore grades declined and extraction costs rose. The easily accessible deposits were exhausted decades ago. New projects require higher capital intensity, longer permitting timelines, and greater energy inputs. Recycling contributes marginally, but fails to close the gap. Electronics disperse silver in quantities too small to recover efficiently. Solar panels lock silver away for decades. The metal is consumed, not circulated. The result was a sustained structural deficit. For multiple consecutive years, global silver demand exceeded total supply. The difference was met by drawing down above-ground inventories, vault holdings, exchange reserves, and stockpiles. Quietly at first, then visibly, those buffers began to shrink. What had once been a surplus system became a depletion system. This is where suppression stopped working. In a balanced market, paper supply dampens volatility. In a deficit market, paper supply disguises scarcity. That distinction is critical. As inventories fell, the paper market no longer represented flexibility. It represented leverage layered on shrinking collateral. For banks acting as market stabilizers, the risk profile inverted. Each incremental short position was no longer offset by confidence in deliverable supply. It became exposure to a delivery failure. What once functioned as low-risk market maintenance evolved into concentrated systemic risk. Stress began appearing in secondary signals. Lease rates spiked, indicating difficulty sourcing metal. Backwardation emerged, an abnormal condition where immediate delivery commanded a premium over future promises. Physical premiums detached from spot prices. These were not speculative distortions. They were warnings from the system's plumbing. At this stage, continued suppression no longer stabilized the market. It destabilized it. Artificially low prices encouraged consumption, discouraged investment, accelerated inventory drawdowns, and increased the probability of simultaneous delivery demands. The mechanism designed to control risk began amplifying it. This was the inflection point markets failed to recognize. Price suppression works only when supply elasticity exists somewhere in the system. When supply is rigid and inventory is finite, suppression accelerates failure rather than preventing it. For an institution with JPMorgan's scale, this reality was unavoidable. The question ceased to be how to control price. It became how to reduce exposure before control was tested. At that moment, suppression stopped being a tool of stability. It became a form of financial self-destruction. JPMorgan's shift did not happen in a single announcement or a visible trade. It unfolded quietly, through positioning changes that only become obvious after the fact. That is how institutional pivots always occur. The first step was retreat. Over time, JPMorgan reduced its role as the dominant short-side liquidity provider in silver futures. This was not a bet on higher prices. It was a withdrawal from obligation. By closing shorts and stepping back from absorbing excess demand, the bank lowered its exposure to a system increasingly dependent on paper settlement rather than physical delivery. The second step was accumulation. While public focus remained on futures positioning, JPMorgan steadily increased its physical holdings. Silver moved into its vaults not through headlines, but through inventory reports. This was not speculative hoarding. It was balance sheet positioning. Physical silver does not carry counterparty risk. It does not require confidence in clearing mechanisms. It settles itself. Holding physical metal inside the system, but outside delivery obligation, changes everything. A bank with physical optionality can choose when and if it participates. It can lend metal at premium rates, withhold it during stress, or simply sit neutral while others scramble. In a tightening market, that optionality becomes asymmetric power. The distinction between registered and eligible silver is critical here. Registered metal is available for delivery against futures contracts. Eligible metal is stored in exchange-approved vaults, but not committed to delivery. It exists inside the system, but outside obligation. When silver is reclassified from registered to eligible, it does not leave the vault. It leaves the market. By shifting metal out of deliverable status, JPMorgan reduced the pool of silver backing the paper market without triggering obvious alarm. Open interest remained. Contracts continued trading, but the ratio of claims to deliverable ounces worsened. This is how stress accumulates invisibly. The importance of this move cannot be overstated. Deliverable supply is the anchor of trust in a futures market. It is the assurance that contracts represent something real. When a major holder removes metal from that pool, the system becomes more fragile, even if prices do not immediately react. This is where historical comparisons often go wrong. The Hunt brothers are frequently cited as precedent. They also accumulated physical silver. They also exposed the fragility of paper markets. But the similarity ends there. The Hunts were outsiders using leverage. They relied on borrowed money and futures contracts to amplify their position. When the exchange changed the rules, they were forced to liquidate. Their power was financial, not structural. JPMorgan operates from inside the system. It does not need leverage. It does not need public accumulation. It does not need to force delivery to win. Its advantage is institutional authority. It understands the rules before they change. It helps write them. Most importantly, JPMorgan does not need silver prices to rise to benefit. It only needs volatility and scarcity to increase. In that environment, physical holders gain leverage, while paper participants absorb risk. The bank's position is not directional. It is strategic. This is the pivot markets underestimate. JPMorgan did not become bullish silver. It became unwilling to remain the system's shock absorber. That is a profound difference. For years, the bank's presence dampened extremes. It provided confidence that someone would always stand on the other side of the trade. By stepping back, JPMorgan did not create demand. It removed resistance. When the entity most capable of controlling disorder chooses instead to insulate itself from it, the implications extend far beyond price targets. Control does not disappear gradually. It fails suddenly, after the final stabilizer exits. When the participant that once anchored the market no longer occupies that role, the market does not immediately break. It drifts. Then it searches for a new equilibrium. And in markets built on leverage and trust, that search is rarely orderly. When the former controller steps away, the system loses its reference point, and without an anchor, even calm water begins to move. Market stress does not announce itself through headlines. It shows up first in anomalies, small distortions that signal something underneath is failing. In silver, those distortions are no longer subtle. Backwardation was the first warning. In a healthy precious metals market, futures prices trade above spot to reflect storage, financing, and time value. When spot prices rise above futures, it means buyers are willing to pay a premium for immediate delivery rather than accept a promise later. That is not speculation, it is urgency. Backwardation in silver signals distrust in future availability, not optimism about price. Lease rates told the same story from another angle. When silver becomes difficult to source, borrowing costs spike. Elevated lease rates indicate that holders are reluctant to part with physical metal, even temporarily. Lending silver begins to carry opportunity cost. In stressed markets, metal is hoarded, not financed. That shift changes liquidity dynamics across the system. Inventory drain made the stress undeniable. Registered stocks, the silver actually available to satisfy futures delivery, declined steadily. Eligible inventories remained, but they were no longer committed. The distinction mattered. Paper claims continued to trade against a shrinking base of deliverable metal. The leverage embedded in the system increased quietly with every ounce withdrawn. Once these pressures converge, the reaction becomes nonlinear. Industrial users move first. Manufacturers dependent on silver cannot afford uncertainty. They secure supply wherever possible, even at higher cost. This hoarding is not speculative. It is operational risk management. When delivery reliability becomes questionable, inventory becomes insurance. That behavior cascades into the investment layer. Exchange-traded funds face pressure as holders question whether paper exposure is sufficient. Redemptions increase. Physical bars are demanded. Custodians are forced to source metal in a tightening market. Each unit removed from circulation compounds scarcity. At the retail level, the disconnect becomes visible. Physical premiums detach from spot prices. Coins and bars trade far above quoted futures prices. Dealers ration supply. Delivery times extend. This divergence is often dismissed as temporary friction. Historically, it is a symptom of structural stress. The pattern is not new. Silver in 1980 followed the same arc. Physical demand overwhelmed the futures market. Exchanges responded by changing rules, restricting buying, and forcing liquidation. Prices collapsed on paper, but the shortage was real. Control was reasserted only by administrative intervention, not by supply relief. Gold between 2008 and 2011 offers a cleaner comparison. As confidence in financial institutions eroded, demand shifted decisively toward physical metal. Futures and ETFs track price, but physical accumulation drove the move.
Much better than this old gold.
Central banks entered as buyers. Gold did not rise because of speculation. It rose because trust in paper assets weakened. Nickel on the London Metal Exchange in 2022 showed how quickly modern markets can break. A large short position faced delivery stress. Prices spiked violently. Trading was halted. Transactions were cancelled retroactively. Confidence in price discovery was damaged overnight. The episode demonstrated that when physical constraints collide with leveraged paper markets, exchanges prioritize survival over continuity. Silver combines elements of all three episodes. Like 1980, it faces concentrated physical stress. Like gold post-2008, it reflects declining trust in financial promises. Like nickel in 2022, it operates in a highly leveraged derivatives framework, vulnerable to sudden failure. The critical insight is that none of these events were ultimately about price. Price was the symptom, not the cause. The cause was delivery. When participants doubt that contracts can be honored with real metal, behavior changes immediately. Liquidity evaporates, volatility accelerates, administrative controls replace market function. This is the stage markets consistently misinterpret. Rising prices attract attention, but delivery constraints drive outcomes. Once delivery becomes the dominant concern, price loses its stabilizing role. It becomes reactive, not informative. What follows is not a smooth repricing. It is a reordering of priorities. Physical access outranks nominal valuation. Optionality becomes power. And those without secure supply are forced to accept terms set by those who have it. This is no longer a story about price discovery. It is a story about whether delivery can still occur at all. Most institutional price targets for silver are already obsolete, not because analysts misread short-term trends, but because their models assume a functioning paper market with elastic supply. That assumption no longer holds. Forecasts built on historical volatility and macro correlations fail when delivery risk becomes the dominant variable. In a market where availability is questioned, price targets lose relevance quickly. This is where the gold-silver ratio matters. For long stretches of history, the ratio clustered near 15 to 1. That relationship reflected both monetary linkage and relative scarcity. Today, the ratio remains multiple times higher, even after silver's recent gains. Mean reversion does not require a return to historical norms. It only requires pressure in the direction of balance. Even partial normalization implies silver moving faster than gold, not because of speculation, but because the starting point is distorted. Several forward paths emerge from here. The first is an orderly repricing. In this scenario, prices rise steadily as inventories continue to drain and new supply remains constrained. Volatility increases, but markets remain open. Futures, ETFs, and physical prices stay broadly aligned. This outcome assumes that confidence erodes slowly and that delivery stress never fully concentrates in one moment. The second path is a disorderly squeeze. Here, one or more large participants demand physical settlement during a period of low registered inventory. Prices gap higher as shorts scramble to cover. Exchanges intervene through margin hikes, position limits, or trading pauses. Volatility spikes. Physical premiums detach sharply from paper prices. The market technically functions, but only through administrative control. The third path is paper failure. This is the least discussed and most disruptive outcome. In this scenario, delivery obligations exceed available metal. Contracts are cash settled against the will of holders. Legal disputes follow. Confidence in price discovery collapses. Physical silver trades independently of quoted prices, and access becomes the primary determinant of value. This outcome does not require conspiracy, it requires only arithmetic. Monetary policy acts as an accelerant in all three scenarios. If the Federal Reserve cuts rates or signals tolerance for higher inflation, real yields fall. A weaker dollar historically supports precious metals, but more importantly, it reinforces the incentive to move out of paper claims and into real assets. Rate cuts are interpreted as stress signals, not relief. They increase demand for monetary hedges at precisely the moment supply is tightest. Conversely, maintaining restrictive policy does not resolve silver's imbalance. High rates suppress investment demand, but do nothing to create new supply. Industrial consumption continues regardless of monetary stance. The deficit persists. Tight policy delays repricing, but it also raises the risk that adjustment occurs abruptly rather than gradually. This is why price is the final variable to respond. Supply is constrained. Demand is embedded in industrial and monetary systems. Inventory buffers are shrinking. Policy tools influence timing, not direction. Markets often assume that price moves first and fundamentals follow. In reality, fundamentals move first and price reacts when no other adjustment mechanism remains. Silver is approaching that point. When every other variable is effectively locked in, price becomes the only remaining release valve, and release valves rarely open slowly. The most important takeaway is also the most widely misunderstood. JPMorgan is not bullish on silver in the way markets typically define the term. The bank is not making a directional bet or issuing a price call. It has done something far more consequential. It has removed itself from the role of sacrifice. For years, JPMorgan acted as a stabilizing counterweight, absorbing demand when the system required it and supplying paper liquidity to keep prices contained. That role made sense when inventories were ample and delivery was assumed. It no longer does. By stepping away from suppression and securing physical optionality, the bank reduced its exposure to systemic failure rather than positioning for upside. This distinction matters. When the most sophisticated participant in a market stops acting as a shock absorber, volatility does not disappear. It relocates. The burden shifts to weaker hands, thinner inventories, and mechanisms that were never designed to carry stress for long. Silver, in this context, is not just another commodity. It is a diagnostic tool. It sits at the intersection of industrial necessity and monetary trust. When silver strains, it signals pressure inside the monetary system itself. Supply deficits, inventory drawdowns, and delivery stress are not isolated events. They are symptoms of a system operating closer to its limits than it appears on the surface. This is why the current moment should not be viewed as a short-term trade or a speculative episode. It is a structural transition. A market that once relied on paper confidence is being forced back toward physical reality. That process is uneven, often delayed, and rarely orderly. But once it begins, it tends to persist. The switch has already occurred. The stabilizer has stepped aside. The assumptions that defined the old regime are no longer reliable. What replaces them will not be decided by forecasts or narratives, but by availability, access, and trust. History offers a consistent lesson here. When markets discover that their foundations are thinner than believed, adjustment does not arrive gently. It arrives when it is unavoidable. And by the time that realization becomes obvious, positioning is no longer a choice.